Happy Friday, everybody. Welcome or welcome back to The Lens. Today, we have a fun favorite. We have Larry McDonald and the Dr. Robert Van Battenberg. This week, we have a special guest from Hudson Value Partners, our friend, client, and contributor, Christopher Davis. We're so excited to discuss everything that happened this past week, everything that we think is going to happen, and important announcement, guys. Remember that you can ask your questions all throughout the video and we'll respond them right here live. Larry, Rob, Chris, go ahead.
Thank you, Valentina. Thank you, team in New York. Chris Davis, the doctor, and I love getting you two together. We were at a really interesting ideas dinner last week in New York, and I wanted to kind of just talk about some of the things that we learned there. What we try to do at the Bear Traps Report is track the birth of a narrative, and with the Bloomberg chat and Discord chat, we can talk to institutional investors around the world, especially with the ideas dinners, and you can see how bought in a trade is or a theme. And over time, you can actually measure, what's priced in. That's the goal that we're trying to do with the ideas dinners. We've done ideas dinners in New York, Geneva, Zurich, London, all in the last 9 months to 18 months. Miami. Chris, you were in New York last week. The private credit situation was interesting. I thought most of all, if you look at, say, CRM equity, I think it's like close to 25-30% off the highs, dramatically underperforming the rest of technology. So you can tell one of the themes that we've been hearing over the last year that I think is picking up with massive intensity is artificial intelligence and the bite on software companies. And if you look at CRM equity, which is a public equity, the destruction there, you're talking about 77,000 employees, Chris. 77,000, right? But if you look at the stock versus the rest of tech, you can tell there's some pain there. And what was the stat at the table? Some 12% of private credit is in that software space. So if the public equities are in this much pain, I wonder how much pain there is under the surface in private credit and software.
Yeah, you really have to wonder how indispensable some of those software companies, especially the smaller ones, are. If a big name like Salesforce has been going sideways since they put it in the Dow at that nice little peak there, you wonder what these smaller companies are doing, and if companies are just going to use AI to make their own agents and own programs, or just use things they have already in stock, so to speak, with the Microsoft license that everyone has.
Right. And, private credit, one of the big wealth managers at the dinner was talking about how regional branch managers and management teams across the wealth management industry have been kind of force feeding the financial advisors private credit. And this has been going on for about 2 years. Once again, picking up with intensity. Josh Brown has been all over this. I love Josh. Josh has had a number of like great long-term calls, but he called it, they're calling it private credit, but potentially the new age of distressed private credit.
Yeah, I think, one of the things we talked about in that dinner was that the credit quality within private credit is a lot closer to what you would see in the triple C market if it was publicly traded and if it was rated in a similar way. And I think that private credit might be one of the best marketing ploys ever. Because if you said to at least half the people who own private credit or sell private credit, hey, actually you're buying, triple C paper, I don't think they would be holders of it. I don't think they would be buyers of it, and I don't think they would be comfortable with it. So it's definitely a buyer beware situation.
Now, one of the things, thank you, Jose, for putting up the triple C's. One of the things that people are talking about this week is triple C's, the transports, some of the regional banks, dramatic underperformance. And last year, and the most of last year, triple C's were grinding tighter as stocks made new highs. We continue to see triple C's, so that's the junk of the junk, massively underperforming equities. That's got some clients, we talk to, credit typically leads equities. You want to see in a bull market, you want to see triple C's grinding tighter with equities, not kind of widening out. This is almost over 100 basis points of widening there. Chris, well, any takeaways from the dinner last week? I think the private credit is a $2 trillion space, and 400 billion of it is in the academic spheres of the world, the Yales, the Harvard, something like that.
Yeah, it's definitely been a big asset class for the pensions, endowments, foundations, and because some of those structures that they're invested in do have, whether it's an evergreen or have some liquidity options, as you see some of these endowments come under pressure, whether it's from taxes or from just a cut in government funding that they're going to have to tap those endowments more. Hedge funds, private credit, which is allegedly liquid, those are going to be where those investors are going to have to draw from to meet the gaps in their budgets.
Right. And what we hear is that Apollo is kind of revolutionary. Uh, they might be setting up a secondary market trading desk in private credit. To me, that's a big signpost because that means Apollo, which is, I think, a much higher quality lender than some of the other players, if they're going to get into private credit secondary market trading, all of a sudden, there's a line in our book, How to Listen to Market Speak. This is a great line. Bestseller now. It's been in the top 5, 10 all week, all month on Amazon. Private credit, mark to market, mark to model, and mark to myth. and so that's what's happening is it's a real joke. It's everybody's vertically integrated, invested in this space, and everybody is basically has the same incentives to kind of not mark things properly. And if the universities are forced sellers, then all of a sudden the regulators are going to start to see some prints, and then if there's a secondary market trading in private credit, you're going to really you're not going to be able to mark to market. I'm sorry, you're not going to be able to mark to myth anymore. Yeah. So once again, transports continue to underperform here. Rob, I wanted to bring you in, Rob. So one of the things clients are talking about, Robert, is that the J.P. Morgan, this fund that's getting bigger and bigger. They said it's like an arbitrage. It's not arbitrage. They basically have set up a collar on the market. Rob, you can get into that, but the month end of options now is so big. The month end, quarter end, and now just option clearing now. I'm sorry for option expiration. You're getting so big that you can see the manipulation in the market where the street there's so many players that need the market to really stop at that expiration target, and the market's actually becoming more and more even in the face of World War III potentially. You're seeing these guys structure the call. How's the J.P. Morgan fund impact this, Rob?
Well, their expiration is by the end of the month. They have a 3-month roll. It's a $20 billion fund. It worked well when it was small. It's the same like story with Madoff, right? Madoff actually was a legit fund when it was kind of nimble and small, and then it became too big and it could never essentially do what it wanted to do, was essentially buy a collar around the S&P and secure people for drawdowns. So this JP Morgan hedged equity fund was a small fund, and it was great. It sold a call above the market to reap some income, and with that, it bought a collar under the market. So if the market would drop by 25% in one quarter, they'll be almost completely hedged. It's a great idea.
So Rob, what happens? So when it gets so big, the bigger it gets, the more people try to game it and trade against them. Or what's wrong with it getting big? Just make it clear for everyone.
They can distort the market in the sense that now JP Morgan is short a call at the strike of let me be very precise, 59.05. So the call is heavily in the money now. They sold that call in the end of March for $70. It's right now at 140, 145. And, traders or speculators can actually try to squeeze now the fund because they know that they have to come in by the end of the month and they have to buy back that call that they sold and roll it into September. So this is what they do. They roll this position every quarter. And sometimes it works the other way around. We saw that, for example, in the fall of 2023, when the puts became heavily in the money, and sort of it becomes a kind of a magnet to use, for speculators to try to squeeze the fund because it's so big and now it's worthwhile to actually force this fund into sort of like forcing it into buying at a very elevated price, much more elevated than it would normally be, just because of the size of the fund. Just to give you an impression, usually the open interest in these out, far out of the money calls is like 4,000 or 5,000. This one is 30. They sold 36,000 calls on this thing, and now it's 41,000, which means that there's about 5,000 of volume that has transpired in this above and beyond what JP Morgan is in this particular call. And you would assume that some of them are real speculators trying to squeeze this fund now. Now,
Right.
Of course, there's a lot of noise in the market now, so it's not the only factor. And offsetting that to some extent is, in fact, the quarterly rebalancing, which is massive at the end of this quarter.
Right.
It's estimated to be $85 billion, but most of it is actually international, not U.S.
Yeah, so it's month end, quarter end, Chris, and then you got the J.P. Morgan situation. You've got obviously option expiration. So there's a lot going on, and what's interesting, the option expiration is getting bigger and bigger and bigger. Chris, one of the things people are talking about this week is the move in oil and its impact on the banks, impact on transports, which we showed earlier. If oil were to stay up here, Chris, any thoughts? I mean, you're on the value side. You're very good. You're very strong at company-specific ideas. But if oil hangs out here 75 to 80, and then all of a sudden that's an impact on a lot of different companies, commercial real estate, the banks, higher for longer comes with a price. Like, it's not free. There's a lot of people out there that thought by now the Fed would have cut the Fed funds rate down to 3%. And now that we have the situation in the Middle East, it creates a lot of problems for the Fed.
Yeah. I would just start off by saying, and I'm not particularly old, but I can say at the beginning of my career, I would have thought that oil would have hit 100 by now, based on the moves and the volatility that we have. And a lot of it, I think, is the strength of U.S. shale and U.S. production that's able to, keep prices relatively low considering all the uncertainty. But when I look at companies in the materials space, example, for, petrochemicals are a big input, whether you're making plastics, whether you are in cement and aggregates and road building and different things, higher for longer definitely plays into those infrastructure plays and can hurt profitability there for sure.
Yeah, and if you think about the Fed, that CPI that was up there. So if oil hangs out here, you're going to be looking at a CPI move higher. And Powell admitted this week, most of the tariffs are not in the price yet because all these companies front ran. So one of the things that we hear this week from our institutional clients behind us in the Bloomberg chat, join us on Bloomberg. If you're on Bloomberg on the buy side only, join us at the Bloomberg chat. Just look up my name, Larry McDonald, Lawrence McDonald, and join us. But, Chris, that's the thing about, if you just look at CMBS here, the banks, higher for longer, a lot of these commercial real estate transactions over the last couple of years were pushed out 1-2 years, kind of forbearance situations. And all that means is, as you can see on the left-hand side of that chart, a lot of these, can you imagine, we're talking like over $1 trillion of commercial mortgage-backed securities were executed, down near 2%, 2.5, maybe 3, between 1.75 to 3. And now all of those are kind of resetting up near 6. You can see that on the top. And as rates have backed up here, it's interesting that the stock market's back on the highs, but you're not seeing commercial real estate spreads tighten anymore. That's reversing, as you can see there. So I think let's get through the slides, Jose, because I want to show Chris. This is like, if you think about the banks, Like if you think of Zions, you think of U.S. Bancorp and Zions, those guys have massive exposure to commercial real estate. And one of the things that we hear is look at the underperformance of some of these banks, right? This is where you can tell there's some potential dead bodies out there because the banks are sitting on a lot of commercial real estate. That underperformance is spectacular. I mean, the market's at all-time highs. Some of these banks are still 20-25% off the highs.
Yeah, no, there's, financials have been one of the better sectors this year, but there's definitely real dispersion within it based on what the bank does, where they are. I mean, it's one of the reasons why, avoiding that real estate exposure is why for us in our Hudson Explorer ETF style portfolio, we've had IAI, which is the broker dealers and exchanges, and trying to get into those areas of finance that are going to benefit from higher volatility. Potentially higher rates for a longer period, as well as just more trading and hopefully that IPO and M&A activity picking up. And it's been a real difference. And those banks are going to have to refinance some of those loans higher, and the real estate sponsors are going to be tougher. Not a lot of them underwrote to double your interest expense.
And Rob, this week MasterCard and Visa off 5, 6, 7%. Very unusual. They're about 16% of the XLF. It's remarkable. The underperformance here of Zions versus the XLF is just shows you how much pain there is potentially in commercial real estate. Rob, what are you hearing on this MasterCard Visa stablecoin situation?
Yeah, so this is an interesting situation because MasterCard and Visa have, even Warren Buffett is loaded up to the gills on MasterCard, I think. Because they thought that they have such a tremendous moat, right? They have such a great moat. They have this payment system spread all over the world. Everybody has to use it. They rip people off 3-4% per transaction, and nobody can then do anything about it. They have a triopoly between them, American Express, MasterCard, and Visa. And right now, for the first time, that triopoly is being put into question by the proliferation of stablecoin and the passing of the Genius Act by the House this week. By the Senate. The House has yet to pass it, probably going to do it by the end of the month. And the backstory here is that Scott Bessent is pushing Congress to pass this Genius Act because he wants to legitimize stablecoin. He wants to proliferate it because the Genius Act requires that stablecoin issuers in US dollars have to have a 1-for-1 dollar liquid asset to back up each stablecoin they issue. So right now, there's about $250 billion in US dollar denominated stablecoins. They will have to buy US bills with that, or repos, or anything liquid. So that's a great source.
How much more bill buying might it be? T-bill buying.
Well, $250 billion. They have to buy it, right?
So an extra 250 billion on top of the current. Is that correct?
Well, but here the story is that if they pass the Genius Act and they sort of legitimize it, there's right now Coinbase already came up with a plan actually to use the existing infrastructure, a blockchain infrastructure from Ethereum and some of these other cryptos to facilitate an alternative transaction system that merchants can use to circumvent MasterCard and Visa. First time, I think that I know that this moat, MasterCard has higher margins than NVIDIA. This is incredible stuff. What do? They just sit there and milk the network. They don't do anything. And for the
explain how will this stable coins hurt MasterCard and Visa? For the simple, for the broad audience to understand.
Merchants can use stable coins to conduct transactions instead of MasterCard's and Visa's network. Once the system is put into place. Now, of course, it may take some time. But if legitimate companies like Coinbase, and we see with the success of Circle, right, that IPO'd at 32, it's $221 right now, and it IPO'd only a month ago. There's definitely an enormous appetite for stablecoin and for a way to circumvent this very onerous duopoly or triopoly that has been skimming off the top of the retail sector for such a long period of time. Imagine the savings alone for Amazon and astronomical. They have $550 billion in sales every single year, of which MasterCard and Visa get like 2-3%.
Right, right. That's yes. Yeah, go ahead,
Larry, so
Chris.
just to chime quickly in on Visa, so we're long Visa at Hudson Value Partners. It's been a great compounder for us over time. I'm taking the stablecoin threat seriously on it, but what I'm trying to square out and think about is the end consumer who's swiping, who's tapping, who's buying online. They're not necessarily going to have those stable coins immediately. They're still going to need a way to buy those. And I think to some degree, your regular credit card companies will still be involved in that. In Visa's defense, when I think about Visa, and I'm on their earnings conference call every quarter, I almost think of them as an identity verification business that's also in payments, because that trusted payment network is very valuable for both consumers, for businesses, and for just making commerce go. And they've done a lot of transactions. I think it's up to billions per year using tokens now. So they are involved in this space. And they also have another business that people don't know about, which is they run the equivalent of TSA PreCheck for some Latin American countries. So that tells you about their identity verification prowess that they would probably still need in stablecoins. And maybe MasterCard and Visa get into the stablecoin business themselves.
But I want to honestly say something else, right? For the longest time, the incredible lobby of Visa and MasterCard has sort of ring-fenced them and protect them from competition, right? Washington, D.C. has sort of been the overlord safeguarding this network. Right now, there's an interest, especially on the executive side, or actually to promote the proliferation of stablecoin, right? Because they want these guys to buy their bills. They need to sell those bills. They have tremendous debt
Right.
to refinance or to issue, right? We estimate $1.7 trillion in the next couple of months. So that protection from Washington, D.C. is disintegrating right now because they want stable coins. They want it as soon as possible because it's a big source. We have listed, right? What are the sources of possible demand for bills? And stablecoin is right up there. It's been one of the visions of Scott Bessent in his recent Senate testimony. He said we could see a $2 trillion market in the next few years for stablecoin. So as before, Washington was protecting the the MasterCard and the Visa networks, and the big lobby groups were essentially, providing a lot of support here. Right now, I think there's two conflicting interests, and I think in the short term we have to take into consideration that protection may actually be fading away.
Yeah, because like your point is, you do have Treasury behind this. You've got the White House. You've got the cabal of White House supporters. Chamath's been doing a great job. Chamath and the All In podcast has been all over this for over a year, and they've been like way out in front. And now it's happening, and you can tell that there's an incredible connection between this stable coin ecosystem and the White House. But guys, we're up at 23 minutes here. Want to keep it short. Have a great weekend. We've got Juneteenth, 4th of July. A lot of vol sellers out there with these holiday shortened weeks. Enjoy the weekend. And Chris, thanks for joining us. Hudson Value Partners. Hey, Chris, how can people find you?
At HVP_research on X, on Twitter. You can also shoot me an email, cdavis@hudsonvaluepartners.com. And just as always, a big thank you to the Bear Traps team and their institutional chat, especially for a boutique firm like us. When I have that chat there, it's like I have just down the hall from me subject matter experts on everything imaginable. And it's such a great group of people. Honestly, I don't even have to ask a lot of questions because oftentimes the answer is already there because so many of the other participants have already been thinking about it. And Larry and his team are always chasing down the answers and thinking about things outside the box. So thank you. It's a great resource and love what you guys do.
Really appreciate it. The doctor, have a wonderful weekend with the family. Valentina, you want to take it from here? Thanks very much.
Thank you guys. Thank you, Chris, for joining us. And thank you, the doctor. You're a fan favorite. Everybody was thanking you last week. So thank you for joining us. Of course, thank you, everybody, for watching this week. Remember, if you're interested in any of the reports mentioned all throughout this video, you're interested in the Bloomberg chat, the Discord chat, please email info@thebirdshopsreport.com. We have a new product coming out, the Washington Pressure Points. Your real intel from Washington here at the Bird Traps Report. If you're interested in knowing what's on the other side of the fence, what are people thinking in Washington, remember to email us at info@thebirdtrapsreport.com. Thank you for joining us. And remember, guys, we're back on the top 5 on Amazon, how to listen when markets speak, now available in Portuguese, Japanese, and Korean. Take yours now. Thank you for joining us, and we'll see you next week. Bye.